Today we're talking about profit targets and volatility. Let's go to the first slide. Our research team put this together for you because a lot of people still write to us about profit targets. And when do we exit a position? 50%, 20%, certain predetermined percentage. But we all know that we exit at 21 DT, we exit at 50% of max profit, we always default to exiting sooner rather than later. Mm-hmm. But how big a difference does volatility make? Because volatility right now is cheap.
Yes.
How much more dangerous is it, or do you change your mechanics in low volatility? Do you, Mr. Batiste?
I do not. Well, do I change my mechanics? It's a trick question.
Is 50% optimal in all circumstances? That is the question.
Sure. I would actually.
You think it is?
I would actually say taking my profits in lower IV rank and lower IVR to be optimal.
You mean
less than 50%?
Less than 50%.
Yes.
Sure. Quicker. I agree with you. Let's go to the next slide. So we're doing a study, 15 years worth of data in the SPYs, 45 days to expiration, 30 deltas strangle for each monthly expiration. We consider the results from using a variety of profit targets from 25 to 65%. Regardless of their P&L, all the positions were exited at 21 days. And we bracketed the results by the VIX level at the time the trade was open. So low VIX, 0 to 13. We're currently above that. Moderate VIX, where we are right now, 13 to 20. Elevated, 20 to 30. And high, over 30. Note that the high VIX only comprises 20 trades. So the results are anecdotal, but not statistically significant.
Easy for you to say.
Let's go to the next slide. Well, there's not a lot of days when the VIX is over 30.
Sure.
All right. So first slide to look at, just because this is where it gets really interesting. When the VIX is really low and your profit target is anywhere from 65%.
But this is low VIX, right? 0 to 13, that's low.
It's
and
low.
they're looking at VIX. Mm-hmm. To give you context, Sadanoff, VIX right now is trading around 17 and change.
Okay. So if you go for a 50% profit, you win percentage is 73%.
Pretty consistent across.
If you go for a 35% profit target, your win percentage is 77%. The problem here is that all of your average P&Ls.
You don't make any money, Saz. You take all the risk.
Nope, that's low VIX. Not
CVR is the same.
CVAR is the same across the board, meaning you don't take a crazy amount of risk, but you don't make any money.
Why, Sosnoff? Why would be the question. Why? Why did you do that?
Why did I do what?
Make these trades with low implied volatility. Why? Knowing this, why?
Good question. Okay. Let's go next slide. This is not IVR. This is
VIX.
So now we're looking at the VIX.
Where we are now.
Right where we are now. And you can see here that if you go to the 50% profit target, it's about the same as the win percentages, as you can tell already, are not going to change much on any of these slides. The average P&L is the big difference, and the CVAR. So at moderate where we are right now, you make money across the board, and your conditional value at risk also goes down. So you take less risk and you make more money. Okay, that's where we are right now. Good. This is what we call good but not great. Mm-hmm. Go to the next slide, please. So when you go to elevated, where we just came from, you can see the profit target at 50%, 45%, and 35% stay the exact same. But the amount of money that you make, because you collect more money, is significantly greater. The average P&L goes up by an average of 3 to 4x. And the CVAR goes down by about 25 or 30%. So you have less risk and you make more money. So where's the perfect sweet spot for trading short premium? Between 20 and 30. You don't get enough chances over 30, and 13 to 20 is like, it's okay, but we're there a lot. Mm-hmm. Under 13, you got to be really careful. And over 30, it's going to be better than these numbers. Let's take a look. It should be.
You hone your skills when volatility is mediocre or medium, or
over 30, you take a little bit more risk, and actually you make a little bit less money. So there is a sweet spot for VIX. And the sweet spot for VIX, and there's slightly lower percentages here. So the sweet spot for VIX is between 20 and 30. These numbers here are a little bit better than 13.
We were just there at the end of May. I mean, 10 days ago, we were sitting right in there.
Yeah. 20 to 30. So we've been in a really good range for traders. 20 to 30 range is the lowest CVAR and the highest average P&L. There you go.
Very nice.
Let's go to the takeaways. So managing winners is a key part of our methodology, but deciding exactly when to lock in a winner comes down largely to personal trading style. In our data set, low volatility was the only market environment where mechanical SPY strangle selling was not generally profitable. In this regime, 50% profit target did the most to mitigate the damage. Strangles sold out of an elevated VIX did best when paired with slightly higher profit target, looking to take full advantage of a larger than usual credit. And balancing risk and reward requires evaluating your trading objectives and what management techniques have been most successful for you. Common sense and a man in a wheelchair, that's what this is. You want volatility between VIX, between obviously as close to, let's call it 20 as possible, but let's say 17 to 30. That's your sweet spot. We're kind of on the low end of that range right now.
Yeah, 17 would make it the low end of the range for sure.